Hi, ladies and gentlemen. Welcome back to our lecture series uh, in the module, the MA1, okay, MA1, which will build into the MA2 module, okay. So, in this second week, we have to look at cost classification and behavior, okay. Where we will be, classifying costs according to their various attributes, okay, and these notes contain all those attributes on how costs should be classified, okay. And if you look here, usually the classification is based on the behavior of the cost, okay, whether it increases with the level of activity or not, okay. But usually this is the main main center of contention, okay, because the whole of this module and the whole of costs and management accounting is centered on the behavior of the costs, okay, their behavior. But we might end up classify these costs in terms of their location, okay. Usually we classify them in terms of their location, where they happen to be occurring, okay. For example, are they factory costs, or are they office costs, head office costs, and so forth. All right. But sometimes we also classify them in terms of their function. For example, are they related to the R&D function, the marketing function, or production function, okay. We may also classify them in terms of the person who is responsible for their control, because sometimes it is not fair to judge a manager, let's say, to blame poor performance of the production manager on the sales manager, okay. To say that, hey man, you guys are not pushing sales, yet the real problem is on the quality of our production. So such type of blame should actually be directed to the responsible manager with the production manager, okay. Costs can also be classified in terms of their type, okay. Are they material, are they labor, this is also a very important classification. Let me just highlight this. The very important classification, okay. This one. Okay, just wait a bit. This is nuts. Sometimes they do misbehave. Usually they do misbehave. I don't like that. I don't like them behaving that way. Okay. Right. This is a very important classification. You see, as we do discuss about other issues ahead, you see that you need basically to know, the types of the costs in a particular situation, and usually they are in terms of material, labor, and other production expenses. You must have just take note. This one is a very important classification. Then lastly, in terms of their traceability, are they direct or indirect? It is also important to know that. However, there is also a very important thing I want you to be acquainted with, okay, the definition of the cost unit, because as we progress, it is very important for us to understand the concept of the cost unit, okay. A cost unit is not a unit cost, as the first the first thing I have to elaborate there. A cost unit is not a unit cost. Okay, it's not a unit cost. It is a unit of product or service to which costs can be related. For example, a room in a hotel, okay, or a patient night, that is the cost of a patient staying in a hospital at night, or a batch of 1,000 shoes. So what we mean here is, it is that thing we can directly adjust costs on. Okay, for it might be a product. Let us just say a product. It's a product. Okay, to which costs can be related. Okay, a unit of a product to which costs can be related. Something that can be given a value. Okay, something that can be given a value for the purpose of costing. All right. Now, why do we need cost information? It is needed for price setting. For us to know what selling price to charge on a particular product, we need the cost information about how it was, how much costs were incurred when it was being produced. For good decision making, okay, for decision making, for price setting, for planning purposes, okay, whether it is feasible and market wise, whether it is feasible resource and market wise. Okay, sometimes a brilliant product can be good for manufacture, but it might not be feasible in terms of marketing. There are no readily available markets for us to sell it. For example, if we have got robots in our warehouses, it's good to have those ones, but is the Zimbabwean market ready to be served with robots? You may discover that it might not be feasible for now, given the poor infrastructure, incessant power outages, and so forth. So the use of robots which may need electricity all the time might not be feasible at the moment. Okay, but we'll need them in future. Right. So that's the purpose of this. There are also cost information is also needed for control purposes. If costs exceed our expectations, we investigate why to prevent future failure, future similar losses, and then for reporting and so forth. You need to actually go through these. All right. Then, what is cost controllability? Okay, it is important from a control point of view. In that control reports should ensure that information on cost is reported to the manager, who is able to take action to control them. Like I said, there's no point in blaming issues to do with the production on the accountant, because the accountant cannot control the processes which are essential in the production process. Those ones are issues to be handled by the production manager, and vice versa. The production manager cannot be blamed on poor billing, poor invoicing, which is the responsibility of the accounting manager. So that's what we are talking about, controllability. A controllable cost is a cost which can be controlled, typically by a cost, profit, or investment center manager. This is a concept whereby we are talking of, usually this will be developed into what is called marginal costing. There are costs which can be controlled, and other costs cannot be controlled, but usually variable costs can be controlled. But fixed costs, in most cases, they can't be controlled. Okay? They can't be controlled. So proponents of marginal costing, they say that it is better to worry about costs which we can handle. That's variable costs. They vary with the activity. If we don't produce, we are not going to incur them. Okay? And all this, that's what we have just talked about. Okay, let's move because we don't have the whole day doing the same thing. Okay, now a unit cost cut. Unit cost cut showing how total cost of a unit, say a pen beetle, is arrived at. Okay, a beetle unit. You can see, okay, a unit cost cut. All right, you can see that the costs of manufacturing this pen have been grouped by type. You can see there is direct materials, there's labor. Okay, material, we needed yellow plastic, red plastic, opaque plastic, etc. Okay, to manufacture this pen. Also, we needed direct labor. Okay, direct labor. This is the labor which is directly involved in the production of the pen. Okay, direct materials. These are materials directly needed or involved in the production of the pen. Direct expenses. These are expenses which are also directly traceable to the manufacture of the pen. Okay. Then, if we add all the these direct costs, we come to what is called prime cost. Okay, all this, their total is what is called prime cost. This one is a very rich, a very common exam question. What is the prime cost? This is the total of all direct costs. Direct costs, that's direct materials plus direct labor plus direct expenses. We come to what is called prime cost. Then overheads, production overheads. Okay, production overheads. And then production costs. Okay, if we add production overheads to prime cost, we arrive at what is called production cost or factory costs. Okay, then we add other overheads, administration, distribution, selling. We come to what is called total cost. Okay, please always have this template in the back of your mind. All right, cost behavior, again in amplification. In the exam, okay, you may be given these graphs. You have to learn to interpret them. Okay, do not be intimidated. Some of these graphs are similar to one another, but you just have to know certain things here. Okay, you need to understand graphs have got axes. Okay, graphs have got axes. The x tells something. If this y-axis, okay, the axis that is vertical, if it is talking about total cost, okay, and the level of activity is horizontal like this, okay, it is suggesting that these costs are as a whole. Okay, not per unit but as a whole. Okay, now one thing you have to know is, because the examiner is not going to tell you is this graph for variable or for fixed costs, you just have to lead yourself. You lead yourself in the exam. No one is going to tell you, hey, this is a graph for fixed costs, this one is a graph for variable costs. You lead yourself in the exam. Okay, you're going to lead yourself, ladies and gentlemen. I will be lying if I say that the examiners are going to tell you If they tell you, there will be another trick ahead. Okay, I'm trying to set this. It's fine. Now, variable costs. These are directly proportional to the level of activity. So if activity changes, they also change. But one thing you have to know, there is a graph of variable costs in total. So total variable costs. This is the graph for total variable costs. Okay. As activity increases, as you can see, this is the arrow for increase. As activity increases, the graph also increases. This is the graph. Okay, this is the graph. These are just axes, but the graph is this on this line. Okay, so as if we were producing A, okay, if we were producing A, the cost was at B here. But if we produced A2, you can see that our cost is also increasing as we are increasing. Okay, so in total, the variable cost per unit is almost similar to the value of y is equal to x. If you still remember that graph, okay, this line that is bisecting the two axes. Okay, this one, that's the graph for variable costs, total variable costs. Okay, but we also have got a graph of variable cost per unit. Okay, variable cost per unit. It is this way. It is a constant. Okay, per unit. For example, e.g., let's talk of labor. For example, labor costs. An employee's wage as an individual is not going to increase even if production increases. Okay, but in total, the wages of these employees is going to increase. This is why in total their wages is going to increase. Okay, because we'll be hiring more labor to do more work. So in total it becomes this one. When employees are grouped together, their labor tends to increase with production. However, individually, these employees, their salary remains just constant. This is why the graph is just constant. I'm sure you get the logic. Let's go to the other graph. Fixed costs. These tend to be constant over a range of activity. For example, factory rent, the managing director salary, and straight line depreciation. They tend to be just constant. This is in total. Fixed costs in total, they are just constant. So you can see in the exam, you can see that the graph, if you don't read this axis, you will be confused. If you don't read the axis, we're talking of, if it is total cost here and you see the line is constant, then that graph is for fixed costs, total fixed costs. But if it is written cost per unit here, then you know that this is a graph of variable costs per unit. This is a very serious issue, ladies and gentlemen. So we are saying in total fixed costs remain constant. Okay, in total fixed costs remain constant. For example, rentals. Even if we produce just 2 units, if we produce, let's say here it's 2 units, we are going to pay the same rent. Okay, even if we produce 100 units, we are going to pay rent. So you can see that the costs are constant over time. You're going to pay the same rent, $100. But this cost, the rental cost per unit, tend to be lower. Therefore, as you can see, okay, over time. Why is it so? Because okay, if we were paying $100 rent when we were producing 2 units, okay, the cost per unit was 100 divided by 2, which is equal to $50 per unit. But when we are now producing 50 units, the rental per unit will be 100 over 50, which is equal to $2 per unit. So you can see that it is decreasing as we increase production. Do you get the logic? I'm sure you do. Now we have got semi-variable or semi-fixed costs or mixed costs. Alright, these are like, for example, telephone or water bills. There is a fixed amount which, even if you do not use the council water, you're going to pay that fixed amount. But then the other one is the variable element, which increases with the amount of water you use or amount of telephone calls you make. Alright, this is a mixed cost or semi-variable or semi-fixed cost. Okay, right. Okay, it's okay. Okay. Oh, I'm sorry. Okay, I'm sorry. Now we have so this is the total cost. In total, they have got this behavior, but per unit, the cost per unit tend to follow, because there is a fixed element. They tend to behave the way fixed costs per unit do. Okay. Similarly, we have got the stepped fixed costs, which are fixed in nature within certain levels of activity. For example, if we have got motor vehicle, in terms of depreciation cost, depreciation. Okay, if we have got 2 cars, the cost depreciation per year tend to be less than 100. But when we increase cars and buy more lorries and so forth, the depreciation charge tends to rise to say 200. And then we make constant for a certain time, and then when we buy other equipment, they increase again and again. So that's it, stepped fixed. So in the long run, in terms of cost per unit, you are going to have, they follow again the fixed cost behavior, but because they are stepped up, they've got this type of behavior. So you must not be intimidated, but when you see this one, you can just tell the examiner that no, this one is a semi-variable or semi-fixed or stepped fixed cost per unit. All right. So there are also these other graphs. Please just read. We do not have time. Let us go straight away to what is called the high-low method. Okay. This is used to estimate fixed and variable costs based on the assumption that within normal or relevant range of output, costs are often assumed to be either fixed, variable, or semi-variable. Mixed within the normal range of activity, costs often rise in a straight line as the volume of activity increases, following some linear pattern. So we have come up with this formula. Use this method. Variable cost per unit can be estimated by this. This is the formula. Total cost at highest activity level. Total cost at highest activity level. Please just remember the wording. Okay, remember the wording. Do not confuse yourself. We are talking of total cost at highest activity, so which means the highest activity here is the major term. total cost at highest activity. Do not take total cost, at highest cost. Okay, but we are talking of highest activity. Okay, some costs might be higher. Some costs might be higher, but at lower activity. They do not apply in this case. We want total cost at highest activity, okay, minus total cost at lowest activity, not just the lower cost. We want total cost at lowest activity. Total cost at highest activity minus total cost at lowest activity. Like in the dollars our top, they separate one another, and then the units are denominators, they separate one another. Do not confuse yourself. Sometimes you end up putting the units on top and the dollars below, which will cost you marks. So let's go straight away into the example. What's the time now? What's the time? 26 minutes. Oh, we are moving. Okay. That's fine. Let's move. Let's move. We don't have the whole day. But when we tell students to listen to the seminars video, the tutors video, they ignore. Guys have to listen to these videos. They are very helpful. All right. Musa Co has recorded the following total costs during the last 5 years. Okay, we have this information. This is the activity we are talking about. This is where you get activity information. Okay, so we are saying that the high-low method wants total cost at high activity minus total cost at low activity, or for us to get the variable cost VC. VC is equal to total cost at highest activity, okay, minus total cost at lowest activity over units at highest activity. Okay, total units at highest activity. Total units at highest activity minus total units at lowest activity. So teacher minus tickler divided by 2ha minus 2la, if you want to go Chinese. Anyway, it doesn't matter. By the end of the day, you just need to pass and move on with your life. Okay, so teacher total cost at highest activity. All right, total cost at highest activity. What is the highest activity? You can see that the 90,000 is the highest activity, so 170,000 minus. So to avoid blunders in the exam, because of exam pressure, just if you take 170, just take the 90 units here, just put them here. Then what is the lowest activity? Lowest activity, the lowest number here, I think it is 60, so that's 140,000 over 60,000, because 140 goes here. This is the combination. These are the combinations we are talking about. These are the combinations. Okay. So 170 minus 140, we get 30,000. 30,000. 30,000. 80,000. I say. Okay, we need here to move. Okay, we need to move, because if you don't move, we're not going to find we're going to find solace in everything we are doing. So let us just move. Okay, let's move. All right, so we are saying that 170,000 minus 140 is going to give us something like 30,000. Okay, that's 30,000, ladies and gentlemen, 30,000. And then 90,000 minus 6,000 is also going to give us 30,000. So 30,000 divided by 30,000, we are going to have $1. So variable cost per unit, that's $1. Okay, that's $1. Okay, am I right here? It's my formula. Okay, now how much should be our fixed cost? How much should be our fixed costs? How much should be our fixed cost? All right, now that we know the variable cost per unit, let us determine the fixed cost per unit in total, rather. Okay, fixed cost is equal to the total cost at highest level, minus total units at highest level multiplied by VC, variable cost per unit. Okay, because we have calculated this VC, this is the variable cost per unit. Okay, so this means that our highest cost was 170,000. Highest cost, I mean the total cost at highest activity was 170,000 minus total units. Total units, they were 30,000, were 90,000. By $1 per unit. This gives us 170,000 minus 90,000. That gives us 80,000. That's 80,000. This is the fixed cost. Okay, the total fixed cost at this particular level. Okay. I mean that's the fixed cost of a period of time. Okay, let's say maybe per year. That's an annual fixed cost. So the question is saying that calculate total cost that should be expected in 2005. Okay, if output is 85,000. Output is 85,000. So if output is 85,000, what we do is, because total cost TC is equal to variable cost plus fixed cost. Okay, so TC in this case is equal to the variable cost VC, which is equal to VC. What is our VC? VC at 85,000, that's 85,000 multiplied by variable cost per unit, $1, and we're going to get 85,000. 85,000. Okay, then add FC. FC doesn't change. FC in total, remember, fixed costs in total, they do not change, they remain constant. Remember our graph for fixed costs. So fixed costs remain at 80,000 even if we produce 85,000, 100,000, 200,000. Okay, so 80,000. If we add them up, okay, we are going to have 165,000. Are we together, ladies and gentlemen? I hope you've been helped with this little calculation. Please, this is why we say that you have to listen to audio or watch video by your trainer, and this is the thing. Just have to replay and replay this audio. Let's move on. The other matters which are very, 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 very pertinent for us, for our attention. Very, 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 very pertinent for our attention. If you have any questions, please don't hesitate to contact me. Somebody's trying to ask questions. We'll answer these questions as we go. Don't worry. Okay, guys, I'm busy. You are. Now, ladies and gentlemen, we are charged with reporting as well. Okay, by the end of the day, we need to report. But for us to report as management accountants, we need to be aware of two important costing techniques. That is what is called absorption. Absorption costing. Okay. And then marginal costing. Marginal. Okay. When we talk of marginal costing, all right, we are saying that all the costs incurred in production are relevant. So we are saying that VC, variable cost, and FC are important. But when we talk of marginal costing, only VC are important, variable cost of production. All right, so that's the trick here. This is why we are having all these notes. But anyway, let us do an example. Let's do example Nobi. don't worry about the pronunciation, okay? But Nobi Co. Okay, Nobi Co makes one product, the cob. At 1 June, there are 40 cobs in inventories held. Each cob requires 2 hours of labor at 1 kg, 1 kilogram of raw material. Labor is paid $8 per hour, and raw material costs $12 per kilo. Novico incurs fixed production overheads of $2,000 per month, and the factory produces 1,000 cobs each month. A cob sells for $35. A cob sells for $35. Sales in June were 1,000 cobs, but in July sales fell to 900 cobs. Hey, you just have to tell yourself that, hey, I want to pass and move on to the next level. Okay, this is very, very, very simple, and we need to show the examiners that we are ready. Okay, so prepare an income statement from Novico under both absorption costing and marginal costing context. Ladies and gentlemen, you need, as an ACCA student, to go online and read a lot about these absorption costing and marginal costing, so that you know the nitty-gritties, the theory about these accounting techniques. Okay, so just love researching and so forth about this. It's very interesting. Okay, so we are going to start with the income statement for the absorption costing. You know, when you talk of income statement, we are talking of sales, less cost of sales, okay, sales less cost of sales, okay, then profit. That's the idea. Sales minus cost of sales, we get profit. Okay, or gross profit here. That's the idea. So if you hear about income statement, these things should come into your mind. Sales less cost of sales, we get gross profit. Simple, isn't it? So let's move on. Let's move on. Can I say something? Can someone say, hey man, you're saying the truth? Okay, let's move. The income statement from Ngabi. So when I arrive at this point, I like to put these pages into, yeah, they just have to share the screen. The pages have to share the screen. Hey man, what happened to my pen? What's happening to my pen? Okay, I want these screens to share one another. Oh man, oh man. That's better. That's better. Can somebody clap hands for me and say, hey man, you married? Okay. Just joking. Damn it, kitty. Okay, yes. So the screen is responding, which is fantastic. Okay, like I said, when you hear these stories about an income statement, let's just say this pen, I don't like it. It's not actually feasible. It's not clear. Okay, absorption costing. Absorption. Use the spelling for absorption, guys. Do not write your own spellings. Absorption costing income statement. Alright, ladies and gentlemen, the first thing we have to do here is to come up with the cost card. Okay, let's come up with the cost card before we do the income statement. Let's come up with the cost card, and we had a template for the cost card, so we must not be vexed. Okay, must not be vexed. We have got that template for the cost card, if you still remember, a unit cost card. So let us just use it. It is now needed here. Okay, so we start with the variable costs of production. Variable, anything you see, direct this, direct that, that's a variable cost. Okay, so we start with direct materials per unit. Direct materials per unit, because we want unit cost card. So it's a per unit, charge on the unit per unit. Direct materials per unit. If you read here from our question, therefore COPs in inventories, each COP requires 2 hours of labor, 1 kilo of raw materials. Labor is paid this and that. Materials cost $12 per kilo. So material, that's 1 kg, required at $12 per kilo. 12 per kilo, and so we are going to have $12. Then direct labor. How many hours direct labor? 2 hours of labor. 2 hours at how much per labor? Per hour, $8. So we need 16 bucks. Okay, so that's, we are not told about any other direct expenses, so we're having 28 bucks. The trouble comes, I'm not good at, okay, using this pen. Okay, fine, 28 bucks. But because we are using absorption costing, so we need to consider also the fixed costs per unit now. And in the question, are we given the fixed cost per unit? Ngabi Co incurs fixed production overheads of 2,000 per month, and the factory produces 1,000 copies. So we are told that in total they are 2,000. But can we slot the 2,000 on in a per unit information? Obviously it can't. So we need to change this fixed cost into units. So divided by how many units are produced, divided by 1,000 units, because we are told here. The factory produces 1000 cups each month. So we are going to get $2 per unit. So the total should be $30 per unit. So each cup is costing $30 to produce. Okay, total production cost per unit, PU. Are we together? Now that we know that the cost of producing a cup is $30, we now know how to determine our cost of sales. Now, ladies and gentlemen, we now know the cost of producing one cup, that is $30 per unit. Let's now do the income statement. Income, AC income statement, absorption costing income statement. Like I said, we start with the sales. Sales. We're told in the question, how many cups did you sell? Remember, ladies and gentlemen, we're having 2 months here, June and July. So June as well as July. So in June we sold 1000 cups as given in the question here. In June were 1000 sales. In June were 1000 cups. So 1000 multiplied by the selling price, $35. So obviously we sold 35,000. These were our sales. Okay, and less cost of sales. Less cost of sales. Cost of sales is opening inventory, opening stock, and purchases or production. Purchases or production. Okay, purchases or production. Less closing stock. Less closing stock. Okay, so opening stock was how much? At 1 June there are 40 cups in inventories held. So we had 40 cups on 1 June. This is opening stock. 40 cups at how much? How much are we valuing these 40 cups? Yeah, obviously we are valuing them at the cost of production of 30. We have determined that the cost of production is $30 in our unit cost card. 30. Okay, so what happens is 40 multiplied by 30 is going to be 1200. 1200. This should not be in line with this one. Okay, then purchases or production. How many units do you produce? We are told that the factory produces 1000 cups each month. So 1000 multiplied by 30. We're going to have 30,000. Okay, if we add them up, we're going to have 31,200. Then less closing stock. Our closing stock, we're told, we had 40 units and we produced 1000 units. That's they become 140, but we only sold 1000. So obviously closing stock is 40 multiplied by 30, $30 per unit, so 1200. So obviously the cost of sales, our cost of sales is going to be 30,000. Okay, that's the cost of sales. We separate this one because we already said less here. This is the figure that is going to be less than the 30,000. Okay, from this one. So we are going to have profit of 5,000. This is the gross profit. So in June we had gross profit of 5,000. Now let's do for July. In July, how many cups did we sell? In July, we are told the sale fell to 900. So we sold 900. 900 multiplied by $35, because each cup sell for $35. So 900 I have to use my calculator. 900 by 35, 31,500. 31,500. Okay, then 31,500. Okay, less the cost of sales. Did we have opening stock? Obviously, since we are in June we had this closing stock. Pens are just the same. Okay, we had this becomes our opening stock. Opening stock 40 multiplied by 30, and we are going to have something like this 1,200. That's the opening stock. Okay, production, how many units were produced? We are told that every month they produce 1,000 cups. 1,000 at $30, that's 30,000. We add them up, they become 31,200. Less any closing stock. We had 40 as opening plus 1,000. That is 1,040. But we only sold 900. So we are left with 140. 140 multiplied by 30. How much is it for the closing stock? 140 multiplied by 140 units multiplied by 30. 140 multiplied by 30. We get 4,200. From 31,200. 31,200. We're going to have 27,000. Okay, this is the cost of sales. We deduct it from the sales. Okay, that's 31,500. 31,500 minus 27,000. We're going to have a profit of 4,500. That's the profit which we have, ladies and gentlemen, in terms of the absorption costing income statement. Okay, now when it comes to the marginal costing, again we start with the, I'm going to do the unit cost card, okay, but I want you to do the income statement for the marginal costing aspect. Remember, the unit cost card itself helps us to determine, okay, helps us to determine the cost per unit, which we are going to use in valuing inventory, okay, which we are going to use in valuing inventory. Okay, you can see that the $30 was very useful in identifying, in valuing opening stock, the production units produced, the closing stock, and so forth. Okay, now under the marginal costing, only variable costs apply. Okay, only variable production costs apply. So we are going to have a situation like this. Direct materials is calculated just the same, direct materials, and we just take these values. Okay, take this value, direct materials, that's $12 because we already calculated it. That's $12. Direct labor is given, I think $16. No other variable expenses were given, so we just total up. This is now the cost per unit. Okay, total variable costs per unit. So I want you to do the marginal costing income statement, and then you also have to do the questions which are in the slide. I hope you have been helped with this audio. If you have questions or scholars, so please feel free to contact me. I'm always there for you. This is where you pay your monies to me. All right, until we meet again, can you just call this one goodbye.